Our speaker is a global thought leader on the future of finance. He's listed as a top 10 global influencer of FinTech Power 50 list in 2021 and 2022. He's an entrepreneur, a writer, and you're gonna love that, a model train enthusiast. And his real life and passion, traveling. When I met him in May in Dubai, he had already traveled to 111 countries. Guess how many he has traveled now? 150. And he has, of course, plans to see all of them. So please, without further ado, put your hands together for the one and only Emmanuel Daniel. Welcome. Welcome.
Thank you very much, good friend.
Good to see you again.
Good to see you. Morning, everybody. I am the founder of reimagine Banker 28 years ago, and in all this time, I created a franchise that has very strong relationships with banks from Korea to Australia, from the Philippines into the Middle East, and now into Africa and so on. And so we are called Untapped Global. But perhaps more interestingly, I am the author of my first book, which is The Great Transition, The Personalization of Finance is Here. And I'm going to be sharing with you a thought that I hope will give you an idea about how to think about the future of finance. The question I'm here to ask you today is, can you imagine a day when every bank in the world will issue a stable coin? Just think about what goes on inside your mind when you ask yourself this question. There's lots happening in the banking world, in the different jurisdictions, in the US, in Europe, and especially in Asia, where I come from, Singapore. At the same time, we're not very clear how the regulators will take the course of the industry. Now, let me preface my ideas for you by reminding you what happened to Kodak. In 1992, Kodak had already introduced the digital camera. 1995, it had become commonplace. And still, Kodak refused to release the digital camera to the general public. It had a dual strategy of thinking that the digital camera belonged to professional users and the everyday man would still be addicted to the physical 35mm film. That strategy worked. In fact, right up to about 2000, the year 2000, the Kodak's share price continued to do well and validated the strategy that it had. 2001, Sony introduced the Cybershot. 2007, the iPhone was invented. And 2010, Kodak went into liquidation. So the question that I ask the banking industry today is, when will and what will be the banking industry's Kodak moment? In the case of Kodak, it loved its 35mm physical film. Its entire business model was predicated around the distribution network that it had globally to distribute the 35mm film. And those of us who are old enough to remember that the advertisements for any number of tourist locations around the world had that camera, that film, as part of the advertisement that they carried. So the question is, what happened at Silicon Valley Bank? When we revisit all that happened in Silicon Valley, or Silicon Valley Bank, we realize that the banking industry has become digital, but is still in love with its archaic infrastructure and its archaic product base. Tuesday morning, I think it was the 8th or 9th of March, Peter Thiel tweeted, "Take your money out of Silicon Valley Bank." By Wednesday, the share price crashed and about $10 billion of deposits were lost from this bank. And after that, several other venture capitalists tweeted, and the deposit base just kept going down until it became insolvent over the weekend. And what was very interesting was that the story didn't stop there. It was, in fact, the following week that Credit Suisse, which has nothing to do with the way in which the US banking industry is configured, also became a victim of social media, of public perception, and then it went down. And then it had a knock-on effect with First Republic and so on. So the reality that the banking industry hasn't internalized is that digitization has its consequences. Now, there's one product that I want you to think about a lot. And just going back to the Kodak story, it is the product that the banking industry loves the most, the humble deposit account. There was a time when the humble deposit account was all about savings, compounded interest that made you wealthy, that helped you keep ahead of inflation, that kept the trust of the banking system with, and the affinity of the banking system with its customer base. But what has happened to the deposit industry or the deposit base? Today we have digital wallets. And what are digital wallets? They are utility platforms that gives access to the user to a variety of digital users in both virtual and everyday life. So the deposit business has transformed already. And today in the digital wallet space, we have a whole range of digital wallets, from simple access to your bank deposits to digital tokens, some of which are cryptocurrencies and stable coins. And what they do is give access to all of us, not just to applications and apps on your phone, but also to gaming and whole new business models that the young generation is now becoming familiar with. So the question to ask the banking industry is, what's going to happen to the digital wallet business in the future? In all likelihood, the transformation of the digital deposit business is endemic and is the most important transformation that the banking industry can think about. The banking industry hasn't kept up with the technology revolution. Just think about platforms and how they're able to onboard millions and then billions of customers, scale very quickly, per transaction cost being minimized to the lowest common denominator, and to be able to carry on multiple transactions at micro valuations. The banking industry still has core banking systems that cannot keep up with the scale that the platform players have become accustomed to. But very importantly, the banking industry missed one very important revolution, that is the API revolution. When you think about Microsoft, when you think about Adobe, you think about SAP, they have now onboarded thousands, in the case of Adobe, for example, nearly 100,000 API developers around their ecosystem. The relationship with the customer base has changed. And yet, the banking industry, through regulation, through its own security measures, have treated the API revolution as a patch solution to solve arcade problems that the bank has internally, instead of using it to reach out and create a new relationship with their customer base. Banking hasn't kept up with the DeFi industry. When we think about what Silicon Valley Bank could have done to fortress and to create the protection layer required for it to respond to new market forces that affects the industry in milliseconds, it could have taken a cue from the DeFi industry. An average bank treasurer has many different challenges in any one day. He has the asset liability management challenge, the trading book challenge, he's got the counterparty challenge, he's got the cost of fund challenge, all of which in the DeFi world is encapsulated in algorithms that can help direct or build relationships and process transactions as quickly as they can. And the other thing about the DeFi industry is that it is 24/7 every second of the day. Batch processes, end of the weekends, goes down at the end of the month. Your bank account is not updated until the batch processes run. Now, some of you might be asking, what about CBDCs? My good friend said that I've been to many countries, and I've actually spoken to the governors of central banks in countries where CBDCs are already live. And the message that I get very clearly is that CBDCs don't work. They don't work for a number of reasons. Think about the CBDC project in China. And I'm very familiar because I have an office in Beijing, and I'm very comfortable and personable with a number of Chinese officials. And guess what? The Chinese CBDC initiative was announced in 2014, it went live it went into a pilot mode in 2018, and it still is in a pilot mode. And it didn't strike anyone to ask, why is it still in a pilot mode? And the reason is that they are too afraid to make it go live because of unintended consequences. And the first unintended consequence of the CBDC platform is that you don't need the banking system if you have a CBDC. It completely bypasses the traditional banking system, the traditional intermediary. And around the world, central banks expect the CBDCs to be promoted by the commercial banking industry. And if you go to countries which already have it live, the Bahamas, Bermuda, and so on, and Jamaica, and so on, the regulators have a hard time making a business case for their regular banking industry to support them. But there are other factors in CBDCs that just doesn't add up. The programmability. In CBDCs, the programmability is closed door, is within the central bank's regulatory regime, and many central banks don't want their CBDCs to be programmable. When you take cryptocurrencies and stable coins, they are open, they've got communities of programmers who are interested to build applications around their various cryptocurrencies as well as stable coins. What's also interesting is that CBDCs are designed to sit over the existing financial infrastructure, especially the cross-border wholesale CBDC projects that are running between Singapore, France, and Canada today. But most interesting, of course, are the real-world issues. Think about this. The truckers' riots in Canada, the politician who couldn't get his bank account authenticated by the regulator in the UK. And stories which tell us that we don't want to give central bankers the authority or the power that comes with CBDCs. But the most interesting one of all is, when I think about the digital wallet experiments that have become live and that are dominant in the world today, such as Alipay and WeChat in China, we completely underestimate the marketing cost that is involved in building these digital initiatives and changing behavior with customers. And there are very few central banks around the world that would want to incur that cost that taxpayers have to carry. Let me ask you a question. Why do fintechs want to become banks? Why is it that so many of the fintechs that started by wanting to become disruptors today ended up wanting to become banks, and especially in the peer-to-peer industry? When we think about them, the answer that I'll suggest to you is because they ended up wanting to sell the same products as banks sell. Just think about this. Zopa, SoFi, peer-to-peer exchanges that wanted to bring borrowers and lenders to meet each other and transact with each other without having the institution itself carry the asset on their loan book or on their balance sheet. But by calling it a mortgage, the regulators get onto you, impose on you a whole list of regulatory requirements that makes you eventually think that you might as well have or apply for a banking license. And when you think of buy now, pay later, for example, it is not a technology business, it's a balance sheet business. You're only as good as your ability to raise funds cheaply to look for low-risk customers in order to be able to make that margin. When your cost of funds is much higher and your customers are high risk, the margins disappear. And so you look at the traditional banks in your respective countries, which have lower cost of funds, better customers, and they always ace you. So the proposition that I will present to you, share with you, and leave as a thought is when the product doesn't change, nothing changes. And this is a message that all of you in the fintech industry will need to personalize, because the more you run after regulators, to please regulators, the more you start and want to look like the banks that you are suggesting to replace, the more you become like the very institution that you thought you were disrupting. And that is why we need to start imagining a world where the product in banking changes. Then you say to me, the regulators are on our tails. So let me tell you how to look at this relationship with regulators. Here are two pictures of Fifth Avenue in New York. One in 1905 looking south, and the other in 1920 looking north. In 1905, Henry Ford had just introduced the automobile. But all the rules were stacked up against the motor vehicle because it was slow, it was noisy, it was heavy, it destroyed the street, it frightened the horses, and the horsemiths up and down the street were afraid that they were going to lose their jobs. By 1920, all those rules just disappeared. They evaporated because the motor vehicle became faster, quieter, easier on the road, more comfortable, and even stylistic. So the financial system that we have today was not built on intent or purpose. You know, when I see Janet Yellen waving this white paper that the Treasury Department had put together on Bitcoin and also on CBDCs, the financial system in the US that affects all the rest of us was never designed but on purpose. The Treasury Department is never able to dictate what the financial system should look like. The financial system, every time it transformed, every time it moved to the next layer, it was because of duplicity, chaos, upheavals, and crises. Just think about it. Central banks. Why was the Bank of England created? To fund a war against France. Why was the Federal Reserve Bank system finally created after nearly 150 years of rejecting the idea of a central bank from the time of the inception of the United States in 1913, I think, right? Because of the banking crisis in 1907, where the wealthy, financiers like JP Morgan asked the state to take charge of the Bank of Final Settlement. And in the same way, Basel I because of the savings and loan crisis, Basel II because of the securities crisis, Basel III because of the trading risks that banks were taking on. The Dodd-Frank Act, Barney Frank is my very good friend. He wrote the foreword to my book. And he will tell you that, and he says this in the foreword to my book, that regulation is always an afterthought because regulators dare not imagine the future. The gold standard, 1971, after nearly 40 years of believing that the financial system should be predicated on the price of gold, the US just unilaterally said that they would not support the price of gold, and they said that it would be a temporary measure. And today, the entire fiat currency system worldwide is predicated on the traded weighted average of currencies against each other. So what are the trigger events that we're looking for or looking at in the future of finance? Let me suggest to you that the internationalization of the dollar is a big process underway where the US does not want to lose its dominance in the global payment system. And so, it is incentivized to digitize the dollar. And the best way to digitize the dollar is to regulate stable coins and enable them to be an extension of the dollar worldwide. The US debt. The US GDP last year was $21 trillion. US debt is now in excess of $31 trillion. The ability to pay its debt is now a moot point. And debt becomes the economy. And because of that, and the funny thing is this, several economists agree, and I buy into this idea, that the fact that the debt is the economy enables the US economy to grow even larger than it is today, on the back of digitizing the economy further. Cybercrimes. The speaker just before me talked about the nature of cybercrimes today, that blockchains are being hacked and the impact of general AI on cybercrimes. That will transform finance as we know it to be, and then the next economic crisis. So I have several themes in my book. The personalization of finance. There's an ice cube on the cover, and I suggest that you read the book to understand why the future of finance is the same as what we've seen in the ice trade. We're moving from platforms to personalization. If you can digitize something, you can financialize it. And therefore, you can financialize almost anything. The mass amateurization of finance, which is the participation of everyday people in the financial infrastructure. And finally, from there, to be able to take stock of what the next financial crisis will look like. So I've said many things in this speech. If you don't remember very much, remember I said just 3 things. If the product doesn't change, nothing changed. And I want to say something else. Remember I said to you that the peer-to-peer players missed the cue because they called their product mortgage, when actually what they were doing was bringing thousands of borrowers to thousands of lenders and enabling them to talk with each other. With generative AI, that conversation is the product of the future in finance. Remember I said that because many of you in intermediation businesses, especially fintech players, are trying to figure out how do you make money by making your customers spend money on your platform. What you really need to do in the next 10 years is to make your customers talk more to each other on your platform. The conversation is the product. And finally, if you want to see or if you want to take stock of where the transformation points in the history of finance will be, look for chaos. Look for crises, not for purpose or intent, because that's where the next phase of the revolution will be. Thank you.